or weighted average cost of capital is an important value used to perform discounted cash flow analysis to value the company. So what is WACC? A company's capital funding is comprised of two components, debt and equity. WACC represents the investor's opportunity cost of taking on the risk of putting money into a company. Let's say the company is funded by 50% of debt and 50% of equity. If debt holders require 10% return on investment and shareholders require a 20% of return, then on average projects will have to return 15% to satisfy debt and equity holders. This is weighted average cost of capital, or WACC. Here's the formula for WACC. The cost of debt can refer to the before-tax cost of debt, which is the company's cost of debt before taking taxes into account, or the after-tax cost of debt. So you would take the cost of debt multiplied by the after-tax proportion of debt in the overall capital structure, plus cost of equity multiplied by proportion of equity in the total capital structure of the company. Calculating the cost of debt involves finding the average interest paid on all of a company's debts, or for DCF analysis, often the current market 10-year bond yield applies. Calculating the cost of equity is a more complex process. Here's a formula for cost of equity. It's risk-free returns plus beta multiplied by market risk minus risk-free return or risk premium for taking equity risk. Risk-free return is basically the return investors require for taking no risk at all. Typically, we would take 10-year benchmark government bond yields. Risk premium for taking the equity risk or market risk minus risk-free return is the additional risk investors require to invest in the overall stock market. And then beta adjustment would be the additional risk investors require to compensate for non-diversifiable stock-specific risk. If beta is larger than 1, then the investment is riskier than the current market risk for the industry, and if it's less than 1, then it's less risky than the current market risk at the moment.